So Bill, Gary, and Chris, first of all, thank you for letting me be part of the presentation again. This is the same Dave Sargent who was here last year with Growth Capital Partners, and it's the first time I've made a presentation where we're actually part of the M&A statistics. We're one of the 6,000 companies that sold for the first 6 months, so we feel like we have a different perspective of the M&A market. I didn't do particularly well in college, as many of you know, so I keep things really simple, which is the stoplight approach. But when we think about M&A, we really think about 6 drivers we think that have the biggest influence on it. So cost of debt capital, access to debt capital, strategic buyers' purchasing power, private equity, taxes, and economic outlook. And I'm not going to go through all these lights, but you do have times, for instance, the second half of '08 and the first half of '09, access to capital, despite being very cheap, there was no access to capital. Nobody could get anything done. So if I go over to 2011, where we are now, cost of debt capital, historically low levels. We'll talk about it later. Amazingly low levels. The access to debt capital, the first 6 months was terrific. It was very strong. The second 6 months, it's not looking as good. It's a little hard to tell just being in July and August, but I think that's something to watch out for. There is lots of strategic buyer purchasing power, which is cash. S&P 500 companies are the best shape they've ever been. The private equity environment is still very robust, which we'll talk about. Taxes have been low for a long time and will be. And the economic outlook, I think, is the other one to worry about a little bit on the horizon. I think in 2010 and the first 6 months of 2011, people felt like there was going to be positive GDP growth, and now people are starting to wonder. So I think that is what could affect M&A in the second half of the 6 months. This chart here is overall M&A volume. So what you can see is actually M&A volume is 31% higher than it was last year for the first 6 months. So that's the first 6 months of 2011 is 31% higher than it was in 2010. The number of transactions is actually lower by about 7%. So one of the themes last year was smaller was better because it was easier to get done and easier to finance. The financing markets have been so strong where the average transaction has gone up significantly. I'll show you on the next page for the middle market. But the total number of transactions has gone down a little bit. So next page is middle market M&A activity, and we look at the middle market as $750 million and below, an area that we spend a lot more time on it. So year to date, the volume is up 21%, and that's the total dollar volume, but the number of transactions is down 18%. So what you have is the average transaction for the first 6 months last year was $50 million, and the first 6 months this year was $73 million. So again, last year was kind of smaller, was easier. It was easier to get things financed for smaller deals because the state of the capital markets, the debt markets have been so aggressive the first 6 months, it's a lot easier to get larger deals done. It is hard to believe the credit markets have come back so much in the last couple of years. This chart here is just kind of an interesting chart. This is M&A by industry, and it's by number of transactions. And you would think it would swing a lot more from year to year. For instance, retail is 2% in 2007. It's 2% this year. Some things have swung around a little bit, but it shows that buyers like to stick to their knitting. If they're comfortable with real estate, that's what they're going to do. If they're comfortable with energy, that's what they're going to do. You know, healthcare has moved up a little. Energy's moved up a little bit, but not as much as you would think with all the things that have turned between 2007 and 2011. If you looked at volumes, this would be very different. But it shows strategic buyers, they like to stick their knitting, and private equity groups, if they're comfortable with healthcare, they're going to stay in healthcare. If they're comfortable in real estate, they're going to stay in real estate. They're not actually going to bounce around very much. Where we live in Texas is energy, so you can see the percentages haven't changed dramatically, but because energy has become a much bigger business and the shale, the percentage of dollar value for energy has gone way up. So in 2010, for instance, energy was 8% of total transactions, but 20% of total dollar value, which was the largest industry classification of M&A last year for value. Next page is something everybody likes to see, and this is, look at the multiples on the left side of this chart, and you can see in 2010 and 2011, the average EBITDA multiple for middle market companies is 8.4, which is really where it was in 2006 and 2005. It's significantly higher than 2009, up from 6.5, and it's still below the peak where things were a little bit crazy in 2007. But you can see the multiples have rebounded significantly, and again, there's a direct correlation between multiples and the credit markets. The credit markets here, this reminds us how bad things got in 2008 and 2009. But if you look at the two red lines, it shows you the spreads in between junk and treasuries are back where they were pre-crisis. And it also shows you actually the spread between treasuries and investment grade debt is even less than it was pre-crisis. So this to me is the biggest surprise. If someone had said that the spreads would narrow and be more narrow than they were pre-crisis 2 years ago, I would have said there's no way. But there's so much money out there and so many people chasing yield. The credit markets have become just incredibly strong. We do think, by the way, that the high yield market in particular has fallen off in July and August, so there's some warning signs going on there. But again, it's hard to tell what's going on in the summer and what's going to happen in the second half. So overall leverage multiples, and I'll pick two numbers here. If you look at 2007, they peaked out at 5.3, and I'll actually pick three numbers. 2009, they were 3.4, which is the low, and today they're at 4.9. So literally, you're at 90% of the leverage you were in 2007, again, given the credit markets. So this, as I was telling guys last night, I have a small account with cash, and actually the $25 annual fee is exceeding the amount that I'm making on my money market, which is hard to believe. But the world needs yield, and so what you have here is you have leveraged loans and high-yield bonds. So the issuance for leveraged loans and high-yield bonds this year is already exceeded what it was last year. People are doing anything to get yield today, and this is what's created these very, very strong credit markets to keep the M&A market going. Strategic buyer purchasing power. Everybody knows about this. S&P 500 companies are in great shape. They have tons of cash, and not only that, their cost of capital is at record lows, which is a very, very important driver for M&A. Private equity, I'll spend a couple minutes on it because it's not something you read about in the papers as much. So private equity, these are institutions, pension funds, wealthy individuals who allocate capital to a separate asset class where they're trying to get higher returns than they will in the stock and the bond markets. You can see it's grown significantly from 1996. But if you look at the bubble years for private equity, 2006, 7, and 8, you had about $1 trillion raised in private equity, and that was about the same amount that was raised the 10 years before that. So lots of private equity was raised then. You can see what's happened since. The private equity, the amount of money has been raised, has gone way, way down and continues to stay down. These are 10-year funds, and it's a 5-year use it or lose it, which we'll talk about in a second. So if you don't use it in 5 years, you've got to give it back to the investors. They have a 2% management fee and a 20% carry, so they don't like losing the money, which will be one of the themes. Today there's 4,000 private equity groups. 10 years ago there was 500. It's or 400. I forget exactly what it was. I'm not sure why you'd know what it was while I was looking at you. But anyway, it's gone up a lot. There's just a lot of private equity. So the next page shows kind of how you break down the classes between LBO, funds of fund, and mezzanine. But for people in this room, which I would say is non-venture capital, 90% of private equity that's raised is applicable to middle market companies. One of the things that's interesting is how little general partners are in Texas. So of all the private equity that's out there, only 4% of the general partners are in Texas. It's really a California or Massachusetts and New York game. So this one here, the gray is what we call the bubble. And what it is the difference between how much private equity has been raised and how much has been invested. So you actually, if you look in 2007, you had more invested than was raised. And all of a sudden, 2008 and 9, you had a lot less invested than what was raised. So you have what we call this bubble. And keep in mind, this bubble, if they don't spend it in 5 years, they actually have to give it back. And so the bigger the bubble, the better it is for entrepreneurs who want to sell their businesses because they're going to pay better valuations and better terms, because if they don't, they have to give that money back. And we estimate for every $100 million you have to give back, you're going to give up $10 to $20 million of economics. Most funds are relatively few amount of people who own it, and they don't like to give up those kind of economics. So the bubble was at a record, as you can imagine, right in 2009, but the bubble is coming down. So what's happening now is they still are not raising a lot of money, but in the last two on the bottom right there, you can see they now are investing more money than they're raising. So that bubble is starting to shrink. It is still a big bubble. It represents about $1 trillion of purchasing power for private equity, but that bubble will continue to go down because they're going to continue for the next couple of years to invest a lot more money than they raise. So great time to look at private equity. I think 2 or 3 years from now, the bubble will not be as big. Another way to look at the bubble is how many years it would take to invest the private equity. So what you do is you take the private equity that's out there and you divide it by what you raised in the last 12 months. So you can see in 2009, it would take 11 years to invest the private equity. Obviously, with a 5-year fund commitment, that is too long. Today, you're kind of down to 3 years. While the 3 years is within that 5, keep in mind a lot of the funds had raised this money in 2007 and 2008, so they are now bumping up against this 5-year hurdle. So we often have private equity funds come to our office and say, listen, I got $150 million bucks. I got to put it to work in the next 18 months. If not, I got to give it back, which I'd rather not do. Quick example of leverage. It's interesting. People say, what's my money, what's my business worth? And it's actually worth different things to different people and how much you can lever. Private equity are users of leverage. It's the only way they can get to 20% returns. So just quickly, if you look at the far left-hand column, in all cases you have a $10 million EBITDA business. In the far left column, you can put 2 times debt on it. And if you want 2 times debt with a 25% return, the business is worth $33 million. If you go to the far right and you can put 4 times debt on it, that same business is worth $65 million. So if I can get 4 times debt instead of 2, I can actually pay twice what the business is worth on the 2 times side. It's really a staggering example of what leverage does for private equity and for owners. So when you had something in 2009 where you could only get 2 or 2.5 times leverage, that same business today is probably worth 30 or 40% more. And the business, the EBITDA might not be that high significantly. The numbers below I won't bore you with, but if he does pay the 67 and can only put 2 times leverage on it, he actually only gets a 12% return. So leverage is very important for private equity guys, and it's something that sellers just have to understand when they get into it. Partly because of leverage, and partly because there's so many different buyers around the world today. This is a deal we worked on a couple of years ago, but we see it with all the ones we do. And again, someone says, what's my business worth? So this is a $20 million EBITDA business. And one guy thought it was worth $94 million, and another guy thought it was $225 million. So it's really a staggering range of 15 people looking at the business. And the guy, it was a very consistent EBITDA grower, and he's sitting there going, how can one person think it's worth this low and one person? Now, we're not the brightest guys in the world, but we did pick the offer on the far left to get this one done. But the other thing about this, in the old days, the strategic buyer with the cheap cost of capital would be on the far left. Private equity groups would be on the far right. There is now so much private equity out there putting money to work. That light blue over there, 3 out of the 4 top buyers are private equity groups. So private equity groups are really competing with strategic buyers, what they haven't historically. And these are just some examples. Some people say, why did you do private equity versus a strategic buyer? Not all business owners are ready to sell the whole company. And with a strategic buyer, it's all or nothing. It's 100%. With this one here, you can just see various examples of the far left. Someone sold 40% of the business. The one in the middle is a deal we did a year ago. It was actually owned by a private equity group. Management had no interest in clearing out. They wanted to keep it, so they were able to go find another private equity group to replace that private equity group, which wouldn't have worked if they had sold to a strategic buyer. The far right, which is a company pretty well in town, Cullen Spitzer, and he didn't want to sell the whole company. He sold 50% of the company to Stevens Group, and that company is probably 10 times the size of it was when he decided to do it before. So these are the type of transactions with a strategic buyer you couldn't do, and it's the benefit of all the private equity that's out there. Taxes is a very short conversation. They're low relative to history, and they'll stay low at least for a little while. So conclusions. We do think, I'm not going to get into the economy too much, but we think the U.S. economy has its challenges. You're in a deleveraging mode for consumers and the government, so we're not that optimistic on the U.S. economy. We are glad that we're in Texas, and we're glad that the rest of the world or the emerging market needs the commodities and the things that we make. On the lower left, I have what could go wrong. I probably could have doubled that up in size. But we're in an interesting environment where I think the M&A window is actually going to open and shut in quicker periods of time than it used to. There's just a lot of things going on. We talked about the euro last night. It's fun having these conversations and solving the issues without having to implement the answer, which is what we did last night. But the euro is interesting. Imagine the United States, we're having trouble agreeing to things. The euro has 17 countries. They all have to agree on what to do. So there's a lot of funky things going on. But we do think the drivers of M&A are actually in really good shape. When the 6 drivers we talked about, the economy is one people are starting to worry about. But the theme that we tell people is the number of people who come in and decide to sell their business, and they're never really sure when they are. They might get to a certain age. They might just get tired of work. They might have an unsolicited offer. But our clients usually aren't ready to sell. And so they come in and say, I've decided to sell, and it takes them 6 or 9 months longer than it should, and they miss that window. And because we think these windows are going to open and shut in a shorter period of time, that's the advice we give to people. Even if you're going to sell 3 years from now, get ready. Whether it's audited statements, whether it's financials, whether it's internal controls, whether it's some ownership changes, you need to be ready, because we have a number of clients who by the time they got ready missed that window. And the window was terrible in 2009, it was good in 2010, so that window can really open and shut relatively quickly. So I have to give my new employer, I now have a boss for the first time in 20 years, which I'm still getting used to, but I got to tell you a little bit about the Duff and Phelps deal. Great deal for both sides. Growth Capital Partners, primarily M&A. We've always been trying to add other services to help clients, whether it's fairness opinions, valuations, purchase price accounting. Duff and Phelps has been talking to us for 3 years. We wanted some international capabilities in some other industries. They have no M&A in Texas and no presence in energy, so my boss is in New York, at least I hope today. So it really is a great fit for us. We have some tools that we didn't have before. It would have taken a long time for us to put together. We can offer clients a lot more services. It's a great deal for Duff and Phelps. They had no M&A in Texas, as I said, so it's been a fun deal, and so far so good, although it's only been 60 days, but I think we have an even better perspective of M&A now that we've done a transaction ourselves. So